No, this is quite a different scenario to anything we've seen in the last 20 or 30 years. Because most of the last 20 or 30 years, we've had economies overheat, rates go up, and then things are slowed down, and then rates are cut, and then that's a normal cycle. This is not a normal cycle. Rates have been low now for many years in many parts of the world, and what you're seeing is a bit of growth, no inflation, and a little bit of growth. So it's quite a different landscape to what we've seen before. So no, I don't think we're going to see a lot of change to the current environment. I think central banks are, on a fine line. They know rates are too low, but on the other hand, they know their economies are not that strong. So they've got to play this balancing game between trying to keep economies afloat without igniting inflation. And if the price to pay is low interest rates for a lot longer than they had envisaged, they're prepared to do that at the moment. I don't think most companies are under-investing. I just think the issue is there's not very much worth investing in. And if you look at a lot of industries, there's overcapacity. There's now overcapacity in the resources sector. There's overcapacity in manufacturing because of what's, the Chinese equation. So I don't think there's huge opportunities for new investment anyway. So I think all this talk about companies under-investing is a little bit overstated, because I don't think there's that many new places for companies to invest their money. Companies are doing enough to stay in business, to keep their operations going. The banks are spending on IT and IT, etc. But in terms of new opportunities, within Australia, there's not exactly an abundance of opportunities to set up a new factory and start exporting, because it's done a lot cheaper out of China. So, I think that's overstated in terms of the fact that companies are not investing enough. It's difficult with the Australian market. It's difficult with all markets, but what you can say, it's difficult to see the share market doing extremely, the index doing well, because you've got 20-odd% in resources, which in the resource sector, which are going to struggle for a while. There's huge oversupply now, and that oversupply is going to be around for a decade in many industries like iron ore or coal. It's not going to go away, next week. So the resource sector is going to be subdued for a while. The banks, obviously, through raising equity, are diluting their EPS, so they're not going to grow in a hurry. So that's probably 50 or 60% of the index, which can't grow they'll have rallies and everyone get excited because iron ore jumps $1 or whatever. But so, and then you look at the balance of the index, that other 40%, where you look at Telstra on a P of 17, 18, Brambles on a P of 18. They're okay, but they're hardly sort of mouth-wateringly exciting, right? So I think the index is hopefully going to be in a range, between 4,800 and 5,300, just to pick numbers. But as I said, we have such a concentrated index in Australia, and if you look at the major components of the index, there are issues, with the resource sector, and there are issues with the banks in terms of earnings growth because of the dilution from all these new equity raises.